Hi everyone, I'm Kunal Sodhani from Global Trading Center, Shinhan, India, and we are here once again with another episode of understanding and decoding the global factors and domestic factors and boiling it down to the currency pairs. So, talking first about the domestic factors, let's understand the flows. The flows have been remaining quite positive when it comes to debt. So, the debt flows for the month of June has been positive to the tune of around 6,000 crores. But if you talk about the overall debt flows for the year, they have been quite positive to the tune of 56,000 crores. But on the contrary, when we talk about equity flows, they have been negative, and for the year they have been negative to the tune of 29,000 crores. On the other hand, if we talk about FX reserves, we are at all-time highs of around $651.5 billion, and thanks to the foreign currency assets, that is the FCAs, which has grown $5 billion since the last week. So the FCAs are standing around $572 billion, which means 88% of the FX reserves of India are confined of the FCAs. All in all, if you talk about these reserves, it covers almost around 11 months of import cover and also creates India as a nation to fight any kind of uncertainties, if any. We also had a recent data when it comes to CPI, which came at a 12-month low of 4.75%. To break down this, food inflation was marginally lower at around 8.69% versus 8.7%, while vegetable inflation was also marginally lower from around 27.8% to 27.3%. If we talk about core inflation, that's the most important, which is at all-time lows of around 2.97%, which excludes fuel as well as food. So CPI was in sync and the comfort zone of the RBI. In fact, on the other hand, we also had the IIP data, which came in low at around 5%, which is at 3-month low vis-a-vis the last number of 5.4%. So this is more from the domestic perspective, but let's talk about the global perspective also, because we also had the data for US CPI number, which came in at 3.3%, where the anticipation was of around 3.4% and the last print was also 3.4%. So inflation data came in better than expected. If we also talk about the core inflation of the US, it came in at 3.4%, where the last number was at 3.6% and previous number and the anticipation, which we can say, was around 3.5%. So all in all, a better number in terms of core as well as the overall number, which again instilled that information into the market where there can be rate cuts starting September. Though if you also see the FOMC policy, which again came out the same day, the FOMC policy was expected as expected status quo. But the commentary and the write-up which we go through the FOMC statement, it stated that they are eyeing only one rate cut for 2024, which was quite hawkish, and for 2025 4 rate cuts. So again, the dollar index, which cooled off sharply after the CPI data towards around 104.5, again bounced back after the FOMC statement. For the euro dollar pair, we already have seen a rate cut by the ECB. I don't know how long it may survive for the rate cuts, but at this point in time, they have started with the rate cuts. Euro dollar pair did touch 1.09 and then cooled off towards 1.0720 levels. If we talk about dollar index as a whole, what we are witnessing is 104. The figure 104 is acting as a very strong support at this point in time, while on the right side 105.52 acts as a resistance. Coming to dollar rupee pair, we have been seeing that it's remaining quite pegged at a range of 83.45 to 83.55 levels. Though we have seen the highest closing of around 83.59 also. But broadly, if we talk about the dollar rupee levels, 83.30 now acts as an important support, while 83.72, which were the NDF highs tested though not onshore, can remain the first important resistance to watch out for. So that's all from my side, friends. Thank you so much and have a wonderful trading session ahead. Thank you.